Hello everybody, today I want to show you how to get from the rental income all the way to the net operating income and to the before financing and taxes cash flow. This video is important for future videos and is the foundation for every discounted cash flow model. Here you can now see the order of the calculation. First of all, for most of the simple residential properties, subtracting the operating expenses of the gross rental income will give you the net operating income. In fact, Investopedia defines the net operating income as the following. Net operating income is a calculation used to analyze the profitability of an income-generating real estate investment. Net operating income equals all revenue from the property minus all reasonably necessary operating expenses. The gross income of a property can be defined as all revenue. The gross rental income is all the rent you receive from your tenant or your tenants. To get to the gross income, we have to add the non-rental income. The non-rental income consists of the tenant reimbursement and other income that comes from the property. Tenant reimbursements, also known as tenant recoveries, are expenses which are paid back to a landlord by a tenant. Common examples of tenant reimbursements include property taxes, property insurance, maintenance and repair costs, and other operational expenses. This is more common in commercial real estate and also differs from one lease agreement to another. An example for other income could be the installation of coin washing machines by the owner. Every time the tenant does his washing, the owner makes a profit. Now from the potential gross income, you have to subtract the vacancy and collection losses to get to the effective gross income. If you want to calculate the vacancy and collection losses for the future, you have to make assumptions on how many vacancy and collection losses you will experience throughout your set period of time. This always depends on each individual property and the lease agreements in place. For example, if you have a fully leased property and the government as your tenant with a lease agreement over the set period of time, it is very likely you do not experience any vacancy and collection losses. In comparison, an apartment complex with several different lease agreements is much more likely to experience vacancy and collection losses. And now, from the effective gross income, we have to subtract the operating expenses to get the net operating income. Operating expenses are the costs that are required to maintain the operational functionality of the property. There are fixed and variable operating expenses. The most common fixed operating expenses are insurance and tax. The most common variable operating expenses are costs for maintenance, repairs, management fees, security for the building, and in some cases utility costs, for example electricity, and other expenses, for example trash removal. I will also quickly show you the next step, but this step is only important for some videos further in the future. If we subtract the capital expenditures of the net operating income, you will get the before financing and taxes cash flow. Capital expenditures are expenditures that improve and enhance the value of the property. They are not required to maintain the operational functionality. Here are some common capital expenditures. But let's look at them at a later stage in more detail. Depreciation and debt service are not taken into account at this stage of the calculation. Now you know how to calculate the net operating income, which will help you to calculate the cap rate of your property or the net initial yield of your property. I will explain how to do that in the next video. If you have any questions, feel free to ask them in the comment section down below. If you liked the video, please hit the like button and subscribe to my channel. Thanks for watching.